In this video, I want to share with you the importance of understanding finance and the principles of an amortization table when you're buying your home. I want to specifically teach you how to save thousands of dollars in interest paid over the life of your mortgage. Woo! Now, whenever you get a mortgage, you get a document called an amortization table that breaks down the amount of interest and the amount of principal that goes towards each payment that you make every single month. And as a general principle, simply the longer that you have your mortgage, the more interest you're going to pay. And when you look at that amortization table, you'll see that in the first 10 to 15 years, the good bulk of your payment is going towards interest. And the more amount of years that the term of your mortgage is, meaning 30 years versus 20 years, on that 30-year mortgage, you're going to have a higher amount of that monthly payment going towards interest each month in comparison to the 20-year mortgage. Now, for the sake of this example, we're going to go over a 30-year, a 20-year, a 15-year, and a 10-year mortgage, but we can actually get you a customizable amount of years that you would like to have your mortgage if it fits the payment within your budget. Okay, for the sake of a straightforward example, we're going to go over an FHA mortgage at a 6% interest rate with a purchase price of $450,000 and 3.5% as a down payment. Now, on a 30-year term, the principal and interest payment on that mortgage is going to be $2,603.55 per month. And over the lifetime of that mortgage, you will have paid over $503,000 in interest alone. So you're paying more interest than the purchase price of the home. Now, in a second scenario, we'll consider a 20-year mortgage where your principal and interest payment will be $3,110.10. And in that scenario, the total amount of interest you'll pay over the life of that 20 years is over $312,000. So you end up saving over $190,000 in interest from going from a 30-year mortgage down to a 20-year mortgage. Now we'll look at scenario 3, where we'll consider a 15-year mortgage. And in this scenario, your principal and interest payment is going to be $3,664.50. And you'll pay just over $225,000 in interest over the lifetime of that 15 years. And then finally, we'll consider scenario 4, where we'll look at a 10-year mortgage, where your principal and interest payment will be $4,821.07. And then the total interest paid over the lifetime of the 10 years is just over $144,000 in this scenario. And so from the big picture perspective, in a 30-year mortgage, you're paying over $503,000 in interest over the lifetime of the loan. In comparison to when you go as low as a 10-year mortgage, you're paying just over $144,000 in interest over the lifetime of the loan. So that's a significant amount of money paid in interest. Now, the one saving grace in this whole perspective is that on your primary residence, you actually get to write off the mortgage interest on your tax return. Now, the main takeaway here that I want you to understand, I use to help save my clients money on their mortgage, is that if you do have the income, there's two primary ways you can save. You can either go the longer 30-year route and pay extra towards the principal every single month, where you'll still end up paying a little more interest over the lifetime. Or if you reduce the loan term, the amount of years, and you pay more towards the principal every month or have a shorter term, higher payment, you're going to save a lot more interest or save money spent otherwise. And so if you'd like to go over a custom mortgage scenario for you and your family's needs, you can find my contact information in the video description below. Again, my name is Ori Pounders, and I'm a licensed mortgage advisor in many states. My license number, NMLS 2013035. Thank you.